In this class, I will continue discussing the short-term decisions that the managers need to make. In this class, I will discuss two types of short-term decisions. First, let's take a look. That's how managers make decisions about dropping a product mix, and sales mix. Deciding which products to produce and sell is a major managerial decision. If manufacturing capacity is limited, the managers must decide which products to produce. If shelf space is limited in stores, then the managers must decide which products to display and sell. Also, managers must often decide whether to drop products, departments, or territories that are not as profitable as desired. So now let's look at how these decisions are made. Some of the questions that managers must consider when deciding whether to drop products or business segments include does the products or the segments provide a positive contribution margin, or will the fixed costs continue to exist even if the company drops the product or segment? Again, in making such decisions, we follow the two cases for such decisions. The first is that the managers should still focus on short term, the relevant data, because this is a type of short term business decision. So the managers must focus on relevant data. Second, the managers should use a contribution margin approach. The relevant financial data are still the changes in revenues and expenses. But now, we are considering a decrease in volume rather than an increase, as we did in the special pricing decision. So in the example of Smart Touch Learning Company, let's see how the managers would use the same process in deciding whether to drop a business segment or department or product. Okay, let's look at this slide. Let's assume that the company's budgeted income statement, the budgeted contribution margin income statements by products, assuming fixed costs are shared by both products, standard tablets and premium tablets. And as you can see, in the third column, premium tablets has an operating income, the operating loss of $5,000. So the management is considering drop the product. So the first question that the managers should ask is, does the product provide a positive contribution margin? If the product has a negative contribution margin, it means that the product is not even able to cover its variable cost. So the company should definitely drop this type of product. But if the product has a positive contribution margin, then it means this product is able to cover some of the company's fixed cost. In this case, as you can see, the premium tablets provide a positive contribution margin of $90,000. So now the managers need to consider the fixed cost. So let's see the effect of fixed cost. Now the company could allocate fixed cost in many different ways, and each way would allocate a different amount of fixed cost to each product. For example, fixed cost could be allocated using traditional method with direct labor hours as the allocation base, by using activity-based costing, or by using some other method. But in short term, many fixed costs remain unchanged in total, regardless of how they are allocated to products or other objects. So, allocated fixed costs are irrelevant except for any amounts that will change because of the decision that is made. So let's see. Considering the fixed cost, what information should be relevant? Here are two questions that provide relevant information, and the managers need to consider. First, will the product fixed cost continue to exist even if the product is dropped? Second, are there any direct fixed costs of premium tablets that can be avoided if the product is dropped? So first of all, let's see the case when the fixed cost will continue to exist and will not change. On this slide, it shows the differential analysis of dropping a product when fixed cost will not change. In this case, as I said, the fixed cost will continue to exist even if even after the product is dropped. In this case, this part of unavoidable fixed cost is called unavoidable fixed cost. Unavoidable fixed costs are irrelevant to decision-making process because they are not changing if the company drops the product or not. So in this case, let's assume that all of the company's total fixed cost of $321,000 will continue to exist, even if the company drops the premium tablet. Also, let's assume that the company makes the premium tablets in the same plant using the same machinery at the manufacturing floor. So, only the contribution margin that the premium tablet provides is relevant. If the company drops the premium tablets, it will lose 90,000 contribution margin. And let's see the differential analysis in detail. If the company drops its premium tablets, the revenue will decrease to $30,000, but variable expenses will decrease by only $140,000, resulting in a 90,000 decrease in operating income. Because in this case, as I said, the fixed costs are unavoidable. So they are not included in differential analysis. This analysis suggests that the management should not drop premium tablets. It's actually more beneficial for the company to lose $5,000 on the product line than drop the premium tablets and lose $90,000 in total operating income. Well, this is the case when the fixed cost cannot be avoided. Next, let's consider another case when the fixed cost can be avoided. In this scenario, instead assuming the company manufactures the premium tablets in the same the same manufacturing facility, let's assume that the company manufactures the premium tablets in a separate manufacturing facility. So in other words, this means that if the product line is dropped, the lease on the facility can be terminated and the company will be able to avoid all fixed costs except $3,000. In this situation, $92,000 of fixed costs belong only to the premium tablet product line. These would be direct fixed cost of premium tablets only. So $92,000 of fixed costs are avoidable. And in this case, this information should be considered relevant to the decision-making process because they would change if this part of cost would go away if the product line were dropped. So this slide shows the differential analysis. It shows that in this situation, operating income will increase by $2,000 if the company drops the premium tablets. Let's see it in detail. Revenue will decline by $230,000, but expenses will also decline and decline even more by total of $23,000. So this results in a net increase to operating income of $2,000. So this analysis suggests that the management should drop the premium tablets product line. Management must also consider whether dropping the products or segments would hurt other product sales. In this example given so far, we assumed that dropping the premium tablets would not affect the company's other product sales, such as the standard tablet. But think about a grocery store. Even if the product department is not profitable, would the managers drop it? Probably not, because if they did, they would lose customers who want one-stop shopping. So in such situation, managers must also include the loss of contribution margin from other departments affected by the change when deciding whether to drop a department. Another example is a company that manufactures dining room tables and chairs. If the company dropped the tables, there would be a definite effect on chairs, as most customers want to purchase chairs that match the table. So even if one product cannot be profitable, I mean, in this case, the managers should consider other factors. Another factor that management should consider is what it could do with freed manufacturing capacity. Well, in smart touch learning example, we assumed that the company produces both standard tablets and premium tablets using the same manufacturing equipment. If the company drops premium tablets, could it make and sell another product using the freed machine hours? Or is the product demand strong enough that smart touch learning could make and sell more of the standard tablets? Managers should also consider whether using the machineries to produce a different products or expanding existing product lines. So here is the decision tree for such short-term business decision. when the manager considers whether to drop a product or segment, they see the revenues, the lost revenues to total cost savings. If the lost revenue exceeds the total cost savings, they should not drop it. Otherwise, they should drop it. Product mix. The companies do not have unlimited resources. So here I would introduce constraints. Constraint is a factor that restricts the production or sale of a product. For a manufacturer like the Smartest Learning Company, the production constraints may be labor hours, machine hours, or available materials. For merchandisers, the primary constraint is display space. Other companies are constrained by like the sales demand. Competition may be stiff, and so the company may be able to sell only a limited number of units. In such cases, the company produces only as much as it can sell. But if company can sell all the units it can produce, which product should it emphasize? For which items should the production be increased? So here are some questions that the management need to consider. First, what constraints would stop the company from making all the units the company can sell? Second, which products offer the highest contribution margin per unit of constraints? Third, would emphasizing one product over another affect fixed cost? Let's continue using an example of our fictitious company, Smartest Learning. Let's assume that the company can sell all the standard tablets and the premium tablets it produces. But the company has only 19,500 machine hours of manufacturing capacity. So, in this case, the machine hours are the constraints of production. And let's assume the company uses the same machines to produce both types of tablets. The data displayed on this slide suggests that the premium tablets are more profitable than standard tablets, as the premium tablets simply have a higher contribution margin per unit and even a higher contribution margin ratio. But in order to determine which product to emphasize, we cannot make decision simply based based only on the contribution margin per unit. Instead, we must determine which product has the highest contribution margin per unit of constraint. So following this logic, the management should emphasize the products with the highest contribution margin per unit of the constraints. Because machine hours are the constraints in this case. The management needs to figure out which product has the highest contribution margin per machine hour. So here, let's assume that standard tablets require 7.5 machine hours to produce, and premium tablets require 10 machine hours to produce. So this slide illustrates the calculation for the contribution margin per unit, per machine hour for each type of product. So we know that standard tablets have a higher contribution margin per machine hour. Well, that's 25.66. $25.66. While the premium tablets have a lower contribution margin per machine hour. So that means the company will earn more profits by producing standard tablets. Because even though standard tablets have a lower contribution margin per unit, the company can make more standard tablets than premium tablets within the limited machine hours, which is 19,500 available machine hours. And they can generate more total contribution margin. So this slide proves that the company earns more total profits by making standard tablets. Multiplying the contribution margin per machine hour by the available number of machine hours shows that the company can earn like more than $500,000 of contribution margin by producing only the standard tablets, but only more than $400,000 by producing only the premium tablets. So now we can, can we make decisions like the company should produce only the standard tablets? Well, based on two assumptions, we can make such managerial decisions. These two assumptions are here. The first assumption is that the company's sales of older products will not be hurt by this decision. Second, the company can sell as many as standard tablets as it can produce. So now let's challenge these two assumptions. First, how could making only standard tablets hurt sales of other products? The retailers who display smart touch learning tablets computers in their stores may want a choice in products so that the customers can compare and choose the tablets that best suits their needs. If the producer produces only one type of tablets, the retailers may be reluctant to display the brands. So sales of premium tablets can be hurt by making such managerial decisions. And let's challenge the second assumption. The smartest learning company has only budgeted sales of 2,400 standard tablets and has the capacity to produce 2,600 tablets. Let's assume that a new competitor has decreased the demand for the company's standard tablets, and now the company expects the sales only to 2,000 standard tablets. The company should only make as many standard tablets as it can sell and use the remaining machine hours to produce premium tablets. So in this case, the company should use only 15,000 hours to make 2,000 standard tablets, and they should use the remaining machine hours, that is 4,500 machine hours, to produce the premium tablets. So this is about the product cost. The product mix. Product mix. Well, for the manufacturers, they have constraints like the machine hours or supply of the direct materials. But for merchandising companies, they also have some constraints, like the display space, because they cannot display all of the all types of products that they sell in the store. So in terms of merchandising companies, they need to consider sales mix instead of product mix. product mix. But the theory behind both of them are same thing. For merchandising companies, they also need to consider the contribution margin per constraint for multiple types of products. And they should focus on the type of product that provides higher contribution margin per constraint. All right, now let's turn to the last type of short-term business decision introduced in this chapter. Now, let's consider how the managers make outsourcing and processing further decisions. First of all, let me introduce outsourcing. Many companies choose to outsource products or services. For example, a hotel chain may outsource its reservation systems. It allows the companies to concentrate on its primary function rather than purchasing and operating an extensive computerized reservation system. By outsourcing, the hotel chain is taking advantage of another company's expertise, which allows it to focus on its core business function. Outsourcing decisions are often called make or buy decisions. Make or buy decisions. Because managers must decide whether to buy a component, product, or service, or produce this in-house. The heart of these decisions is how best to use available resources. And here I would like to introduce a concept, opportunity cost. Because it is important for companies to consider opportunity cost in this decision. Well, opportunity cost means the benefits given up by choosing an alternative course of action. This is opportunity cost. I will continue using the example of smartest learning to illustrate the points here. Let's assume that smartest learning is deciding whether to make the casings for its tablet computers in-house or outsource the production to another company that specializes in producing casing for computers. By producing the casings in-house, the cost per unit is $23. But the other company offers to sell the smartest learning company the casing for only $21. So the question is, should the company make the casing or buy them from another company? Well, initially, by first glance, by, by first glance, it seems that the smartest learning should outsource the casing simply because the cost of outsourcing is lower than making it in-house. Or in other words, $21 is less than $23. But the correct answer is not so simple because manufacturing cost per unit contain both fixed and variable components. So, in deciding whether to outsource, the managers should assess fixed and variable costs separately. So first, let's assume that smartest learning company cannot avoid any of the fixed costs by outsourcing. In this case, the company's fixed costs are irrelevant to the decision because the company should continue incur the fixed cost. The company, because the variable cost of outsourcing, that is $50,400, is more than the variable cost of making the casing by itself. So by such analysis, we know that if the fixed cost cannot be avoided, the company should continue to make its own casing. Next, let's consider another case, that is the fixed cost can be avoided. Let's assume that the management can reduce the fixed cost overhead by $12,000 by outsourcing the casings. The company still incur direct labor cost, direct material cost, and variable manufacturing overheads. In this case, fixed costs become relevant to the decision because they differ between alternatives. So this slide shows the differential analysis, and it shows that even with the $12,000 reduction in the fixed cost, it will still cost the company less to make the casing than to buy them from the outsourced company. The net savings from making the casing is $2,400. This slide also shows that the outsourcing decision follow two key guidelines, as I mentioned in the start of this class. First, focus on relevant data. Second, use a contribution margin approach that separates variable cost from fixed cost. But note how the unit cost can be deceiving. If smartest learning manager made their decision by comparing the total manufacturing cost per casing to the outsourcing unit cost per casing, that is $23 versus $21, they would have incorrectly decided to outsource. If you can recall that the manufacturing unit cost contains both fixed and variable costs, while the outsourcing cost is strictly variable. So to make the correct decision, the company has to separate the two cost components and analyze them separately. So here is the decision tree for making such short-term business decision, whether to outsource or not. If the differential cost of making the product exceeds the differential cost of outsourcing, the company should outsource. Otherwise, the company should not outsource. A similar type of managerial question is to sell or process further. That means at what points in processing should a company sell the products? Many companies, especially in the food processing and natural resource industries, face such business decisions. Companies in these industries process a raw material to a point before it is saleable. For example, a dairy processor pasteurizes raw milk before it is saleable. The company should decide whether it sells the pasteurized milk as it is, or process the raw milk further into other products such as the reduced fat milk, butter, sour cream, cheese, or some other dairy products. So here are some questions that the managers should consider when making such business decisions. 1. How much revenue will company receive if it sells the products as is? 2. How much revenue will the company receive if it sells the products after processing it further? 3. How much will it cost to produce the product further? So here, Let's consider another example from Smart Touch Learning Company. Suppose the company can sell its tablet computer as is, or add the front accessible USB ports to the tablets. The cost to add USB ports is $5 each. This cost includes the cost of modified casing, the USB components, and the labor to add the components. This feature is very popular to computers, and tablets with this feature sell for $20 more than tablets without this feature. So this slide shows the differential analysis for this decision. The smartest learning managers do not consider the other costs incurred in producing the tablets. Well, for these costs, they are called the junk cost. Joint costs are the costs of production processes that yield multiple products. Joint costs are considered to be sunk costs. If you can recall from our previous discussion, that sunk cost is a past cost that cannot be changed regardless of which future action the company takes. So in this case, Smartest Learning has incurred the joint cost regardless of whether it sells the tablets as is or processes them further by adding the front accessible USBs. So the joint costs are not relevant to the decision. By analyzing only the relevant information, the manager sees that they can increase profits by $36,000 if they add the USB ports. The additional revenue of $48,000 overweighs the additional 12,000 cost of extra processing. So this is the decision tree for sell or process further question. If the additional revenue from processing further exceeds the additional cost of processing further, the company should process the product further. Otherwise, if the additional revenue from processing further is less than the additional cost of processing further, the company should sell as is. Stop processing further. So this is the end of this chapter. To summarize, by making short-term business decisions, we need to focus on two key guidelines. The first one is that the managers need to focus on only relevant information. The second one is that the managers should use a contribution margin approach that separates variable cost from fixed cost. All right, this is the end of this class. Same thing, before I leave, please let me know if you have any questions.
Thanks, Professor. Have a good weekend.
No more questions? All right. I will see you guys in the next week. In the next week, we will start chapter 26, which is the last chapter. And that chapter focuses on long-term business decisions. So see you next week. Bye-bye.